Welcome everyone to US Dex Export Exchange. I'm William Laux, and this month we're going to be doing something a little bit different. With 2020 finally coming to a close, we thought we'd look forward to 2021 and talk about the three key factors that will impact dairy markets and trade in the year ahead. Let's get started. The first factor is of particular relevance to our viewers here in the United States, and that's that we are going to have a new president in January. Under the new Biden administration, we should anticipate a couple of potential changes of relevance for dairy markets. Firstly, as we film this in early December, it remains unknown whether two U.S. Department of Agriculture programs that were initiated under the Trump administration, namely the Farmers for Family Food Box program and the Coronavirus Food Assistance or CFAP program, will be renewed going into next year. Why this matters for dairy markets? Well, the food box program has been one of the key drivers in the unprecedented level of volatility affecting spot cheese markets here in the United States, which you can see on the graph. If the program does conclude, cheese prices would be driven much more by supply-demand fundamentals rather than sharp, short-term fluctuations in government spending. That would mean prices will be much more stable in 2021. CFAP's potential conclusion would also influence dairy markets, but a bit more tangentially. Primarily, if CFAP dollars are more limited in 2021, U.S. farmers would receive much more direct signals from the market on whether to increase or decrease milk output in 2021. Stephen is going to talk a bit more about milk output in a second, but ultimately, market conditions could be the driving factor next year. Finally, a new administration will also have an impact on trade policy. While we don't expect major changes in policy right away, existing trade disputes and tariff actions may be alleviated over the next 4 years with a greater emphasis on multilateral negotiation on those difficult issues in the trade space. Therefore, similar to the cheese market, we could see more predictability in the policy arena. Ultimately, though, a change in U.S. government will probably mean fewer shocks to the market, both positive and negative, caused by government action. Instead, it will be driven much more by dairy fundamentals. So let's turn it over to Stephen for the second key factor to talk about some of those fundamentals that are going to be driving dairy markets in 2021.
Thanks, Will. The second key factor is one that we've talked about before and Will covered in depth in our last video, but it bears repeating, and that's milk supply. As we finish 2020 and move into 2021, there has been and will be a lot of milk on hand. Milk production was up in October, again by 2.3%, continuing the pace of increased production we've seen throughout most of the year. Overall, in the third quarter of 2020, milk production was up 2%, and it's anticipated to be up through the end of the year. These increased levels of production are also expected to continue in 2021, with some suggesting we may experience levels as much as a 3% increase in the first few months of 2021. A contributing factor to this is the rate at which we're adding to the herd. In October, the industry added 14,000 cows, which continues the 4-month-long herd buildup and brings the herd to just shy of 9.4 million cows. All this to say, there's a lot of milk out there and it needs a home. Additionally, and as Will spoke to, the market has been impacted by a number of government programs that, whilst providing support to the industry during this unpredictable year, have also led to producers not clearly receiving market signals to adjust production accordingly. As the programs end, clearer signals will likely emerge. However, it may mostly be too late to correct what is looking like a year shaped by oversupply in 2021. Now, what exactly does this mean for 2021? Increased milk production needs a place to go. Demand moving into 2021 is questionable, as government support programs likely end and food service also likely continues with a sluggish recovery. What this translates to is a likely buildup of stocks, as the industry tries to handle the increased volume of product. These stocks will weigh on the market through H1 and likely throughout the back half of the year as well, which will put some downward pressure on price at least until we can enter a time frame of more predictability in the market and draw down those stocks. Now I'll turn it back over to Will for our final factor.
Thanks, Stephen. Now to the final factor, and that's the one we've all been living with over the past year, COVID-19. At time of recording, news of several effective vaccines making it through trials and 2 requesting emergency authorization for use from the US's Food and Drug Administration gives us reason to hope for the year ahead. Hope that by the time we're recording our look ahead to 2022 video, the worst of COVID-19's prevalence, human and economic cost, and restrictions on daily life may be behind us. But until we get to that point, much uncertainty remains. Reports indicate that a vaccine will begin to be distributed in parts of the world by Q1, but how quickly and how widely it can be distributed to the general population is unknown and will vary widely by country. But once that happens, I am expecting a surge in food service consumption and thus dairy demand as people begin to gather again and celebrate that they can meet safely. You can see here on the chart to the right that in the US, consumer spending on food away from home, i.e. at restaurants, fell dramatically, down 29% from March to September, but food at home purchases did not increase by a similar extent, up 5% over that same period. That is, of course, the cost of COVID-19. But in spite of the pandemic, overall dairy consumption has fared well. But the closure or lack of activity at food service did have an impact on overall dairy demand, especially here in the United States, as you can see on this graph. While we don't have similar data for most international markets, consumer surveys and anecdotal evidence suggest the data would be relatively similar. Thus, a safe reopening will be fundamentally very bullish for markets as food service demand recovers. But again, the question is when? As I said, each country will vary based upon vaccine distribution, COVID cases, and overall safety to gather in groups. But even with that caveat, there are still reasons for optimism on the horizon from a public health standpoint. However, in 2021, COVID-19 will have an impact beyond just public health. It will also impact the economy and consumers' wallets, which I'll turn over to Stephen to cover.
Thanks, Will. The total economic impact of COVID-19 on the U.S. and global economy won't be fully understood until we're completely past this pandemic. However, the impact has taken a toll, and despite some levels of economic recovery, we're still far behind where we were pre-COVID. In terms of GDP, the U.S. saw a tremendous drop starting in Q1 and through Q2, where it saw the steepest drop in economic output on record, falling 9%. However, not to be outdone, Q3 recorded the most dramatic increase in economic output on record, climbing over 7%. This is representative of the volatility the economy has seen throughout 2020. And while this seemingly V-shaped recovery is promising, this is looking at the economy in aggregate. Broken down by industry, food service and hospitality sectors are likely lagging behind this level of recovery. Looking at the unemployment rate, there was a staggering rise from 3.5% in February to 14.7% in April. And while these levels have steadily come down since then, it's still unclear just how many jobs will be coming back in sectors like hospitality and food service. However, what this boils down to is that there's less money being spent in the economy, both through individuals cutting spending due to lost wages, fear of losing wages later, or through closures of outlets to spend money at, notably food service. Personal consumption expenditure fell roughly 19% from February to March. And while expenditures have rebounded sharply from April, spending is still well below the trend we were on pre-COVID. Overall, as the economy is able to reopen following a vaccine, we expect to see a rebound in food service, and along with it, increased use of dairy products in that area. However, the timing of when that will happen is the big question. As Will stated, there are vaccines that are close to being available for widespread use. But until that happens, we have to continue to operate under the circumstances at present. So that's it for this episode of Export Exchange. Feel free to reach out to Will or I for any comments or questions, and we look forward to talking to you in the new year.